but we will take turns kind of hosting these various webinars. So we're really happy to have you with us today. I will be presenting the information, and Sam's going to be monitoring the chat and dealing with that side of things for today. And this is the very first of our series that we're calling Thrifty Thursdays, and it's about building credit with a credit card. This is, oh, well, there you go. There's our official title. Oh, Sam, are we recording this? Oh, great. Okay. If you would like captions while you're listening, you can find the CC button, the closed caption button at the bottom of your Zoom window. There's a little picture here that shows you what it looks like, hopefully. Just looking for mine right now. I'm going to look under more. Mine's listed under more. It just says captions. You can turn it on there. Okay, here's some pictures of Sam and me. We are both extension educators, so we work for University of Minnesota College of Extension, and our job is to take information that's developed on the campuses and share it with people all across the country, really, through these webinars, but definitely across the state. And then we also bring information and questions back from people in the community and share with folks at campus to see if we can find answers to your questions. So it's a really fun job. And we both focus on financial capability, which is why we're doing this today. And I also work on issues around family relationships. Okay, so as I just said, Sam and I work a lot in financial capability, which is another way to talk about money management or personal finance. And so when we teach these classes, just like today, we don't have a ton of time. And so we don't get very frequently to get into the kind of the nuances of how you might do the things we're recommending to you. So we developed this Thrifty Thursdays series to look at things in a little bit more detailed perspective, so we could help you strategize ways you could act on the recommendations we give you in our more basic budgeting classes. So in general, this is a cycle that I use all the time, and you might have seen before if you've ever taken a personal and family finance class. It starts up here at the beginning with set financial goals, but essentially I think of building credit as an essential part of budgeting and money management. Very few of us have just hundreds of thousands of dollars in savings these days that we can use to make major expenses. And so we usually need to borrow money at some point in our lives. And having good credit makes it much easier to borrow money and much healthier to borrow money. Okay, so as I just said, credit plays a big role in our financial lives. Here's some examples of how credit plays a role. It can influence or affect our ability to be employed, or it might get us fired sometimes, depending on the kind of work we have. It affects our housing, sometimes by the interest rate we can get when we're borrowing money for a mortgage to buy a house, but it can also affect your ability to rent a place, or the amount of a deposit, security deposit you might have to pay. It affects our transportation, again, and if you need to borrow money to buy a car, then the interest rate you can get will be determined in a large part by your credit score. But also the insurance rates that you pay are often nowadays influenced by your credit score. So it really influences that. And I'm sure probably all of you have a cell phone, and you know that if you've ever gone to buy one, they will quickly check your credit and make decisions based upon that. So all of this stuff is influenced. So I'm actually not, I don't think it's a good idea that all of these things are influenced by our credit score, but they are right now. And so given that that's the fact of life, I would like to be able to help you develop strategies for making yourself look as creditworthy as possible for lenders. Okay, so here's an example of why I think it is worth it to focus on your credit score. Essentially I've created a little tiny version of an amortization table for you in this yellow box here. So if you were to imagine that you were going to buy a used car, let's say, so you wanted to borrow $7,000 to buy that car, and then you've chosen to repay that $7,000 in 4 years or 48 months. That's known as the term of your loan. So then what I've done is I've looked at how much money you would wind up paying overall based upon your interest rate. So I took an interest rate of 11%, one of 7%, and one of 3%. And for each of these, you can see a difference in the amount that you pay. With an 11% interest rate, this first little square here, you would be paying $181 a month. And of that $181, only $117 is going to pay down the principal, or the amount of money that you initially borrowed. $64 of the $181 is going to pay interest. So that by the time you finish the 4 years of paying off that loan, you've paid $1,684 just in interest. And the total amount that you pay is $8,684 on a $7,000 loan. Now let's skip down here to the 3% interest rate. And with that interest rate, your monthly payment is already almost $30 less per month. And most of that money is interest that you will not be paying. So of the $155 you would pay with the 3% interest rate, 137 of that is going to pay down the principal, which again is the amount of money you borrowed in the first place. And only $18 are going to pay down your interest because you have so much less interest to pay. And so over the life of the loan, you will pay $437 in interest, meaning that the total amount that you pay is $7,437. So you can see you save a lot of money if you are able to get a lower interest rate. And one of the best ways to get lower interest rates is to have a high credit score. So I'm going to show you some ways that using a credit card can help you improve your credit. Okay. Now, sorry, I got to move my little Zoom bar down again. So how do you use credit cards to build good credit? Because there are other ways you can build credit as well, and I hope you will do those too. But one way you can use credit cards is think of it as a tool to improve your credit. Don't think of it as a way to buy things you don't have the money to pay for. Instead, think of it as a way that you are going to use money that you have anyway to build your credit. Okay, so the way you can do that is by paying your bills, your credit card bills consistently and on time, staying well below your credit limit. And most financial experts recommend that you never carry a balance of more than 30% of your credit limit. So if you have a credit card that has a $1,000 credit limit, you want to try to have a $300 balance or lower as the total maximum that you would ever have on that credit card. I hope that makes sense the way I explained that. You also want to try to avoid unnecessary fees. You can do a lot of that by like not charging over your credit limit or paying your bills on time, that kind of thing. And then if you can, possibly each month pay more than the minimum payment. And if you can pay the whole thing in full every month, that would be excellent. And that's what I would recommend you build into your strategy. And then another thing you can do to build good credit using credit cards is to have at least 3 active lines of credit. So that's something that lenders will be looking for. They want to know that you have more ways to borrow money than just the one that they're going to be offering to you. So you want to show them through your active lines of credit that yes, you have other ways to borrow money, you've done it, and you've used that responsibly. So you can come up with 3 active lines of credit in a number of ways. And a line of credit just means someone that you're currently repaying money to. So if you have student loans, for instance, and are paying those back, that's an active line of credit. If you have a car payment or a house mortgage, those are active lines of payment. Any credit card that you use is an active line of credit. Well, it's a line of credit. And so to make them active, you have to be regularly paying on them. So you want if you have 3 active lines of credit, it kind of puts you in this perspective of like, oh, that person's an active user and they're using their credit responsibly, basically. Are there any questions so far, Sam?
Not yet.
Okay.
Well, there was one, but I answered it.
Oh, okay, great. Thanks. Okay. So let's talk about smart credit card use, because it can very easily get out of control. You're not alone at all if you have a difficult time managing your spending when it comes to credit cards. They're designed to be difficult to use. So you have to be very strategic when you think about it. But the way I recommend you practice smart credit card use is to have a credit card and then use it only to build your credit. So you want to use that credit card to pay for one affordable regular payment. So you might use your credit card to pay when you fill your car with gas. One time a month, use that credit card to pay. And then when you get the bill for that payment, if possible, pay that in full every month, because then you're not charged any interest on the charge. And you get all this good credit for appearing to use your credit card, but you don't have any of the downsides of being charged interest. So if you can, pay the card in full every month. And then don't use that credit card for anything else. Even one regular payment per month will kick you into the active line of credit category. Okay. And if you have to put that card away in order to not use it, that's just fine. Just put it in a drawer. I have a picture of a freezer here because there's kind of a funny story that's always told among financial capability educators, that they recommend you use that credit card the one time and then you put it in a bowl of water, put the bowl of water in the freezer so that your credit card gets frozen into a block of ice. So next time you want to use it, you got to wait and thaw it out before you can use the credit card. Of course, clever people will say, oh, well, we can just put that number in our phone or our computer. It'll save those things. But you get the idea. You want to build in barriers for yourself if you are feeling tempted to use the credit card. Okay. So another question that I get quite a bit about using credit cards is, how do you get started? Like, how do you get your first credit card? Or what if you've had difficulty with credit in the past, and so your credit score is very low and someone won't give you a credit card? That happens from time to time. And what the Attorney General recommends, and I think Sam and I also think it's a great idea, is getting a credit card, a special kind called a secured credit card. So a secured credit card is, as I write here, a credit card tied to a savings account that you hold at that same bank or credit union. And what makes it secured is that any amount of money that you spend using that credit card is secured by the amount of money that you have in a special account in the bank. So your credit limit for a secured credit card is the same amount that you have within the special savings account that you set up when you take out a secured credit card. So let me show you how it works. First of all, you need to find a bank or credit union that has secured credit cards. Most of them do, so you don't need to look too far. But if you have a bank or credit union that you already work with, that would probably be a good place to take a secured credit card out of. And you just go to the bank and tell them you want to open a secured credit card account. And they will ask you how much money you want to put down to secure the credit card. And so what you will do is think of a certain amount of money that you want to have in there. And there's usually a minimum amount. It's around $250 or $300. So let's say you decide you want to put $300 into a special account to serve as your credit limit for your secured credit card. Let me show you a little picture here. So over here on the left is the secured credit card bank account. So this bank account that has your money in it kind of works like a CD. They're often interest-bearing accounts. So you might even earn a little bit of money with the money that you have in your special account there. And then you also have a regular bank account. And that's just your normal like checking account, let's say, where money flows in and out. Once you get your secured credit card, then you start on your little strategy where you have one affordable payment per month. And you decide to use it to buy something like a trip to the grocery store, let's say, and you use your secured credit card for that one thing. Then you don't use it for anything else. When the bill comes in, you pay the credit card bill in full using money from your normal bank account. Don't use the $300 over here, because this money is just supposed to be in case of emergencies if you're unable to pay the credit card bill. Otherwise, you want to pay from your normal bank account, because if you wind up having to have the money pulled out of your secured credit card bank account, it will make your credit limit go down. So right now you can use that card to charge up to $300 worth of purchases. And then when the money comes in, you pay from your regular checking account. And then this $300 still remains. But if you're unable to pay from your regular checking account and you have to use this money and it's withdrawn, then you won't be able to use your secured credit card until you put more money into this special account. So you want to keep this here just in case and pay for your charges using your regular checking account. Then after usually about 6 months, you have established probably a good enough record using the secured credit card that you can get a more traditional credit card that's not secured, so you don't have to tie up your money in this way. And then you can withdraw it from this account and, do whatever you would like to with it.
Sharon, we have a question with secured credit cards. Is there
Okay.
often an annual fee or not?
It probably depends upon the card, but that would be a good thing to check about. I would say probably a lot of them are designed to help people establish credit. And so my hope is that they wouldn't have a lot of fees associated with them, but it's a good thing to find out before you start using it. Good question. The other thing you want to make sure of before you get the secured credit card, you want to make sure that whoever the bank or the credit union is, reports the activity of that secured credit card to the credit bureaus, because that's the whole point. You want the credit bureaus to know what you're up to, basically.
The other question is, does the 30% rule still apply to secured cards?
I would say yes, it would, because they want to see that you are it's called utility or utilization rates. So they just in general don't like those to get too high. They want to see that you have more money available to you if something were to happen, basically.
Correct.
Yeah, good question. Okay, any others right now?
Yes, there are.
Okay.
So another question is, when it comes to secured cards, is how is the money untied when it is time to close the secured card or transfer to a traditional card? Does that impact your credit score?
Oh, good question. I don't think it does. I think it's okay. You just, because you're opening up a new credit card with probably a larger credit limit, that usually it might impact your score for say a month, but then it will be okay. I guess you could continue to use it if you wanted to, but the downside of those secured credit cards is that you get that money tied up in there that you can't have access to.
Yeah. And when you do close it, you would get that $300 back or whatever you had to put down.
Yep, it's your money.
Yep.
It's just you keeping it in this one special account.
And the other, just, you asked about opening up to a traditional card. As long as you're not opening up 5 traditional cards, plus buying a car, plus doing all those things, that's what's going to affect your credit score. If it's the only, credit you've opened in the last 6 months, that won't affect it as much. And it's usually just a couple of points it runs. Another question for you, Sharon.
Okay.
Do you build credit when you use your debit card as a credit purchased?
Oh my gosh, that is so great that you said that. I have a slide about that, a couple slides from now. No, you don't. Debit cards, even though they look exactly like credit cards, are not the same thing, and you don't build credit using them, because debit cards are just a way for you to quickly withdraw money from your own checking and savings accounts. So you're not borrowing money from anyone when you use a debit card, you're just taking out your own money. So the whole thing that is special about credit and credit cards is that you're showing that you are repaying money to someone you borrowed money from. So for any of this to be meaningful, the activity of repaying the money needs to be reported to the credit bureaus. So because you're not borrowing money when you use a debit card, it won't show up as good behavior.
Yep. Even if your transaction says credit, or sometimes you'll get the option at the pay station to select debit or credit, and some people will run a debit card as a credit, but it's not getting reported. So
yeah, that's just to make it even more confusing. I think that just means you don't have to put in your PIN. That's the only thing that credit thing means at the pay station. Okay, great questions. Any more right now?
I'm saving it for later because I don't remember if you talked about it or not, so.
Okay. So anyways, this is how secured credit cards work. Over a relatively short period of time, you will begin to see your credit score climb. That's another thing that I'm not sure everyone is aware of, but if you begin to like strategically work on improving your credit, you can see a lot of improvement. And again, like I said, a relatively short period of time. It's a pretty responsive tool that they use. So just as if your credit goes down a little bit when you close a credit card, as you were asking about or something like that, you'll see it bounce back up relatively quickly, as long as you have other things to account for that. Okay, here's the question. Remember, here's my slide where I was addressing credit versus debit. So great job for asking already. All right, and then here's my official spot to ask for questions.
Okay, so there's one that I didn't have you answer, and then another one that just came in. So the first one is adding your child as an authorized user on your credit card, does that help them establish credit?
I don't think so. It's a good question. Let me think about that. Do you know, Sam?
So to me, the wording of an authorized user it would be if they were like a applicant on it.
Mhm.
But I think we'll investigate that and
Mhm.
let you know for sure in our follow-up email. Because sometimes there's those little, just nuance on what does that mean? So we'll look into that question. And our other one is, what is the best way for me to track my credit score?
Great question. There's a lot of options for that nowadays. So I can only, I mean, it kind of depends upon who you are. And I will start off by saying that there are some ways, there are new businesses that say they have a credit score for you, like Credit Karma, and they do have a credit score. But Credit Karma is tricky because they come up with a score that might be close to what the 3 credit bureaus have for a score, but isn't exactly the same. And oftentimes it seems to be a little higher than maybe what the credit bureaus have for you. And so the problem with that is that when the lenders go to look at your credit score, they're only looking at the 3 major credit bureaus. And so sometimes people get a bad surprise when they're like, wait, I didn't know I thought mine was higher than that. When I looked at Credit Karma, it said it was higher. And that's because Credit Karma uses a little bit different formula. But Credit Karma is still useful, I think, because you can check your credit score there very regularly, and you can see the direction that your score is moving, if it's rising or lowering, and that will go in the same direction as your scores on the 3 major credit bureaus. But I find that there are a lot of organizations like banks I belong to or credit cards that will have my credit score now that you can just check at those different places, and I can check it anytime. It's free, and nobody has all 3 of the credit scores, but they have a variety. Usually I can figure out what my score is for each of the 3 major credit bureaus by going to different people that I work with, like the bank or a credit card or an insurance company, something like that. Do you have anything to add to that, Sam?
No, I do have more questions. What
Okay.
is the ideal range for our credit score?
Oh, yeah, good question. So generally the scores range from about 300 to 850. So I once heard a speaker say that if you could get your score above 653, that put you in line for getting the best rates on loans. I would say, the higher the better, but you don't need to worry about it too much until you're ready to borrow money or use your score in some way, so you have time to work on it. What would you say, Sam? Do you have I usually shoot for anything above 653.
Yeah, I was gonna say, according to Experian, anything above 670 is in the good category, and then you move up to very good and exceptional. And that's where you'll really see a benefit in your interest rates. So, all right. And then our next question is, so somebody's asking about if there is a specific and strategic time between statements to make a full payment of the last statement.
Yeah, like you want to get credit for paying it off. I think you just need to wait till it gets sent to you as an official amount that you owe. Once that's given to, once you get word that here's what you owe, then you can pay it in full, no problem. But I don't think it would be in your best interest to like charge it one day and then pay it off in full the next day. You might want to wait.
Yeah.
Do you have an opinion, Sam?
The biggest thing is that I know people who will like go buy groceries and then they get home and then they pay off those groceries immediately, like 5 minutes after they bought groceries. That's not going to necessarily show up. You need it to hang out for a little bit. So, you get your statement, this is what you owe. And then if you are able to pay it at that moment, you don't have to wait for the due date, but it does need to be sitting there for a little bit. That could be a day or two. This is the fun part about credit card companies and the FICO score is that they don't give us any information, just they don't hand it over. It's like a well-kept secret. So
Yeah.
we do have another question. A person asked is, if you have a credit card that you do not use, does that affect your credit score?
It probably there's some other things that weigh in, like how long you've owned the card. I mean, how long you've had the card, if you used it in the past. If you're not using it, do you carry a balance that you're just, you're not currently paying on, that kind of thing. If you have it and it's got zero activity on it and zero balance, I would say, but you have other things to counter that, it's probably not super harmful. But if you could think of a way to use it for like one affordable payment per month, you might see a bump in your score.
And just the other things, I worked with clients who have had credit cards that they have no balance on, haven't used. They've actually closed that account because due to inactivity, and that's depends on the credit card, but most, if you haven't used it in a year, they do have the right to close it. And so that could hurt, especially if it's, a big amount that you have open and available to use. So just be aware of that as well.
Mm-hmm.
One person asked, what percentage limit should one have on their credit card? I think that was the 30%, that 30% of your, do you want to explain that again, Sharon?
Yeah. So if you have a credit limit of, I always use $1,000 because it's a round number. So you want to have basically, if you can, don't have a larger balance on your credit card than 30% of your credit limit. So if your credit limit is $1,000, then you don't want to carry a balance ever of more than $300. Does that make sense? So you could technically charge up to $1,000 using your credit card, but the credit bureaus don't look favorably upon that, and the lenders don't either. They like to see some room in there where you could maybe charge a little more if you needed to, basically. So keeping it at 30% or below is just a rule of thumb that financial educators suggest. And again, it means you can't buy a ton using that credit card, which is sometimes people are disappointed to hear that. But if you can't pay your credit card bills, it's really most healthy to try to keep the spending low when you're using them.
Okay. Our next question asks about choosing a credit card when they would like to get cash back, special offers. How do I decide whether or not to get a credit card from a business I frequently buy from, for example?
Well, yeah, again, a lot of things come into play. How many credit cards do you currently have? And do you expect to be using that, into the future? Because once you have it, then as Sam mentioned, it's kind of hard to get it off of your credit report then without taking a hit. So you want to just think carefully about, do you really need that credit card? Or are you going to get enough benefit from it to warrant having the card? It might be you're getting a ton of benefit from it. And so, okay, do it then. But if it's something that's just, you're getting maybe like just a one-time special deal or something like that, it probably wouldn't be worth it to get that. So you have to weigh the pros and cons of it for your personal situation. I can say if you already have some credit cards, you might look at the perks that are included with those and see if you can use those credit cards to pay for whatever it is that this place is that you use a lot. Maybe you could get good perks using those credit cards as well.
Mm-hmm. The next thing is, what is the difference with the FICO score and the 3 credit score? I get confused on this a lot, and they are not the only one.
Yeah, so the FICO stands for Fair Isaac Company, and they're actually a company that are based in St. Paul. So they're local, and they have a special mathematical formula that they use. So the credit bureaus are the people, they're like the people who collect all of the credit information. So that's what I mean when I say that the lenders are reporting to them. So like banks, credit card companies, mortgage companies, the Department of Education. If you are borrowing money and repaying loans, all of those people will send information to their credit bureau that they work with to say, hey, this person paid their bill on time this month, or, they'll send that information. So the credit bureaus are the ones that just collect the information. Then they work with the FICO folks, and the FICO people take all that information. They do their top secret mathematical formula that none of us know exactly what it is. And they come up with a score based upon the information that the credit bureaus have shared with them. And then they send that score back to the credit bureau and say, okay, based on the information you shared with me, here's Sharon's credit score. So the reason why the scores are different for each of the 3 credit bureaus is because they each have a little bit of different information about you, because different lenders don't typically report to all 3 credit bureaus. Some of them report only to 1, some report to just 2. So they'll have a little bit slightly different information about you. And that information goes to FICO. FICO's formula gives a different, score based upon the little bit different information. But generally, each of the credit bureaus, the scores will be pretty close to one another. They're usually kind of ballpark of each other. Does that make sense?
And so FICO score has been around for ages. You will have start to see things called like Advantage score. I'm trying to think of what else I've seen. And those are other companies, typically credit companies that don't want to pay FICO. And so they're coming up with their own mathematical formula that they think. But when you apply for a car loan, mortgage, those sorts of things, they are looking at the FICO score, not the other score, because that's the standard.
Yeah. Before it's almost time, it may be time for us to officially end, and I'm happy to stay on and answer more questions, but if you need to go, I want to show you, we have some resources for you here, and we will be sending these out to you in follow-up information. So one is a little video series we created here, this Building Blocks of Financial Capability, and we have 4 videos about the different aspects of credit. So those are free to use, and they're on our YouTube page. And the next one is from the Minnesota Attorney General. It's called the Credit Handbook, and it has a ton of great information about credit, building credit, protecting yourself, that kind of stuff. And then the final one is just a whole section on credit from the Consumer Financial Protection Bureau, or the CFPB, which is a national bureau that works to help all of us in our money management stay healthy. So we'll be sending those out to you as well. Oh yeah, and then if you need a certificate of participation for this, we're going to be sending you an evaluation. And when we send you the evaluation, you fill it out, and then after that, you get a chance to go get your certificate. And then if you're doing this to get well-being points, actually, I have to read this myself. Yeah, you get 200 well-being points per webinar. That's pretty good. So, same thing. You take the evaluation, and then there's a chance to get the points after that. So I better get you this link. Here it is. Let me put it in. See if I can do this. Can you put it in there, Sam? Can you put it in the chat for everybody?
No.
I can.
Thanks. All right, we have a few more questions while Sharon's putting that in the chat. The first one is, can a person get a free copy of your credit score? And actually, if you have a credit card, you would probably be able to see it on your credit card or your credit card company. But your credit report is what makes up the credit score. And you can get free copies of your credit report from each of the bureaus. So Experian, Equifax, and TransUnion. All 3 of them, once a year, you can get a free copy of your credit score or credit report, and that influences your credit score. So without knowing what's on your report, you can't really understand why you have the score you have. And like I said, those are free. We'll include the website. It's free credit report, I think .com. With our follow-up email, And that will show you what is affecting your credit score. If you apply for a credit card, for a loan, you do have the right to see your credit score if they pull it up. So that is that question. And then our last question, if you have more, like Sharon said, or if you need to go, we also understand, but we'll try to finish answering questions. Is there a difference between you closing a card and the issuer closing it for lack of use? And I'm thinking that's, how does it affect your credit report? Do you want me to take this one, Sharon, or?
Oh,
you-
sorry, I'm still trying to get this doggone link in here.
Okay.
All right, I got it. Woo! There's the evaluation link. All right, sorry, what was the question again?
The question is there a difference between you closing a card and the issuer closing for lack of use?
Oh. I mean, I don't know that for sure, but my guess is no. If they're closing it for lack of use rather than for you defaulting on your loans, my guess is that would be pretty similar. It's just, you're just kind of cutting off one piece of access to money basically by closing it. And so, but it won't look bad, like you still owe a lot of money that never got paid. So I think it would be pretty similar. That's my guess.
And the biggest thing is when a card is closed, is that we talk about the credit utilization rate. And when you close a card, if you had $5,000 limit, you no longer have that 5,000 to utilize. So whether it's you closing it or the company closing it due to lack of use makes a difference. If they close it and you have a balance, then you get into the charge off and other territory, possible collections, and that will have more of an effect. But if it's zero balance, it should not affect as much. Okay, then there was another question. Is it better to have more credit cards to build faster credit, i.e. 3 credit cards versus 6 credit cards?
I don't think it's terrible to have 6 credit cards. You just want to make sure you don't get into debt by using them. So if you want to have 6 credit cards and put one affordable payment on each credit card, then that's, a good way to have active lines of credit. And so you just want to make sure you can manage to do it. So I think 3 would be okay, but 6 is certainly not way outside the realm of how many credit cards people have. It's probably below that.
Yeah.
Well, it's probably a little above the average, right?
Yeah. And you also want a credit mix. We didn't really get into that as well. So just having credit cards may not be the best way because you don't have secured and unsecured debt. And things are ranked differently according in, this magical FICO formula. So it may not be, the more credit cards you would have possibly more to borrow from, but it doesn't mean that it's going to affect as positively as you would think versus having a home loan, mortgage, a car loan, a couple of credit cards, the type of credit cards, that kind of stuff too. So good questions. Okay. So again, Sharon has put in the evaluation. We'll hang out for a little bit longer to see if anybody else has questions, but